Surplus and shortage, when markets fail to clear. In our previous journey through the mechanics of the market, we discovered this sweet spot, that perfect intersection of the supply and demand curves where the market clears and everyone leaves satisfied. We saw how the invisible hand naturally guides the price to a point of equilibrium. But the world of finance and economics is rarely static, and markets do not always sit comfortably at that perfect point. Sometimes the price is too high, sometimes it is too low. In this lesson, we're going to explore what happens when the market fails to clear, resulting in surpluses and shortages. We will also look at how external forces, such as government intervention, can prevent the market from reaching its natural balance. To understand corporate strategy and investment, John must know how to recognize these imbalances and predict how the market will react. Let's start by looking at the situation from John's perspective as a producer of custom mechanical keyboards. Imagine that the equilibrium price for a high-end keyboard is $200. At this price, the number of keyboards John wants to make exactly matches the number of keyboards his customers want to buy. But what if John, perhaps being a bit too optimistic about the value of his brand, sets the price at $300? According to the law of demand, at this higher price, many of John's potential customers will decide the keyboard is too expensive and walk away. At the same time, according to the law of supply, John is highly motivated to produce as many as possible to capture those high profits. This creates a surplus, or what Gregory Mankiw calls excess supply. John's warehouse begins to fill up with unsold inventory. Bins of keyboards are gathering dust, and his capital is tied up in products that aren't moving. In a free market, this surplus is a powerful signal. To stop the bleeding, John and other sellers will eventually lower their prices to entice buyers. This downward pressure continues until the surplus is gone and the market returns to the equilibrium of $200. For John the investor, a surplus in a company's inventory is often a red flag, signaling that they have miscalculated market demand or overvalued their product. Now, let's flip the scenario. Suppose John tries to be the nice guy of the tech world and prices his keyboards at only $100, well below the equilibrium price. At this bargain rate, demand explodes. Every coder on GitHub wants one. However, $100, John can barely cover his costs for premium switches and circuit boards. He isn't willing to work the extra hours needed to meet this massive demand. This creates a shortage or excess demand. John's website shows out of stock across every model. Frustrated customers are sending him emails, offering to pay extra just to get to the front of the line. This shortage creates upward pressure on the price. As John sees the desperate demand, he realizes he can raise his price without losing customers. As the price climbs back toward $200, the quantity demanded tapers off, and John's incentive to produce more increases. The shortage is resolved when the price hits the equilibrium once more. However, the most critical part of this lesson for a student of economics is understanding what happens when the market is not allowed to reach equilibrium. This usually happens through government intervention in the form of price controls. There are two main types: price ceilings and price floors. A price ceiling is a legal maximum on the price at which a good can be sold. Imagine the government decides that keyboards are a basic necessity for the digital age and mandates that no one can charge more than $80 for one. Since $80 is below the equilibrium price of $200, the market faces a permanent shortage. John has no incentive to produce quality keyboards at that price, but everyone wants one. This leads to long wait lists, black markets where keyboards are sold illegally for higher prices, and a decline in quality as John cuts corners to save money. Mankiw often points to rent control in cities like New York as a classic example of a price ceiling that, while intended to help the poor, often results in a shortage of housing and poorly maintained buildings. On the other hand, we have the price floor, which is a legal minimum on the price at which a good can be sold. Suppose the government wants to protect keyboard manufacturers and decrees that no keyboard can be sold for less than $400. Since this is way above the equilibrium price, we get a permanent surplus. John produces thousands of keyboards, but almost no one buys them. The market is stuck. This is frequently seen in agricultural subsidies or the minimum wage. While a minimum wage is intended to help workers, if it is set significantly above the equilibrium price for unskilled labor, it can lead to a surplus of labor, which we commonly call unemployment. For John, understanding these distortions is vital for risk management. If he is looking to invest in a sector heavily regulated by price controls, he must realize that the natural signals of supply and demand are being muffled. When markets fail to clear, it creates deadweight loss, a loss of total efficiency where neither the buyer nor the seller is as well off as they could be. For John, the lesson is clear. Prices are more than just numbers on a tag. They are essential signals that convey information about scarcity and value. When a surplus or shortage occurs, the market is trying to tell John something. As a producer, he must listen to the signal and adjust his price or his production. As an investor, he must look for these imbalances to find opportunities or avoid traps. Whether it's a warehouse full of unsold cars or a line of people waiting for the latest smartphone, the mechanics of surplus and shortage are always at work, driving the world toward that elusive, ever-changing point of equilibrium. By mastering these concepts, John stops guessing and starts calculating, moving one step closer to the financial mastery required in the modern world. In our next lesson, we will dive into elasticity to see just how sensitive John's customers really are to these price changes.